Financial scandals have long been a dark cloud looming over the global economy, with billion-dollar frauds and corrupt CEOs at the center of attention. These scandals not only shake the foundations of businesses and investors, but also have far-reaching implications for the entire financial landscape. The significance of these scandals cannot be overstated, as they have the power to erode trust, destabilize markets, and tarnish reputations on a massive scale. When we delve into the world of billion-dollar frauds and corrupt CEOs, we uncover a web of deceit and manipulation that can have devastating consequences. From Enron to Bernie Madoff, these high-profile cases serve as cautionary tales of unchecked greed and unethical practices. Understanding the intricacies of these scandals is crucial for anyone navigating the complex world of finance, as they provide valuable insights into the pitfalls to avoid and the warning signs to watch out for. Join us as we unravel the mysteries behind these financial scandals and explore their lasting impact on businesses and investors alike. The rise of Bernie Madoff's Ponzi scheme. Bernie Madoff, once a respected figure in the financial world, shocked the industry with the revelation of his elaborate Ponzi scheme. As the founder of Bernard L. Madoff Investment Securities LLC, Madoff presented himself as a successful and trustworthy investment advisor, attracting clients with promises of high returns and steady profits. However, behind the facade of legitimacy lay a web of deceit and fraud that would eventually unravel in spectacular fashion. Madoff's Ponzi scheme came crashing down in 2008, exposing losses of billions of dollars and leaving a trail of devastation in its wake. The aftermath of the scandal was profound, with investors losing their life savings, charities facing financial ruin, and regulators scrambling to understand how such a massive fraud could have gone undetected for so long. The Madoff scandal served as a wake-up call for investors and regulators alike, highlighting the importance of due diligence, transparency, and oversight in the financial sector. It underscored the need for increased vigilance and stricter regulations to prevent similar schemes from happening in the future. The lessons learned from the Madoff scandal continue to resonate, reminding us of the dangers of unchecked greed and the importance of maintaining trust and integrity in the world of finance. Enron, the fall of a corporate giant. The Enron scandal remains one of the most infamous cases of corporate fraud and misconduct in history, leading to the spectacular downfall of a once mighty energy giant. At the heart of the scandal were fraudulent accounting practices and a culture of deception that permeated every level of the organization. Key players in the Enron scandal included top executives such as CEO Jeffrey Skilling and CFO Andrew Fastow, who orchestrated complex schemes to manipulate financial statements and deceive investors. Their actions ultimately led to Enron's bankruptcy in 2001, causing shockwaves throughout the energy market and raising serious questions about corporate governance and oversight. The collapse of Enron prompted a wave of regulatory changes aimed at preventing similar scandals in the future. The Sarbanes-Oxley Act, passed in 2002, introduced stricter accounting standards and increased transparency requirements for public companies. These reforms were designed to restore investor confidence and hold corporate executives accountable for their actions, signaling a new era of corporate responsibility and oversight in the aftermath of the Enron scandal. The corruption of Tyco International's Dennis Kozlowski. Dennis Kozlowski, the former CEO of Tyco International, became synonymous with corporate greed and excess as details of his financial misconduct came to light. Kozlowski's lavish lifestyle, funded by company funds, included extravagant purchases such as a $6,000 shower curtain and a $2 million birthday party for his wife, all at the expense of Tyco shareholders. Kozlowski's actions eventually caught up with him, leading to legal proceedings that exposed a web of embezzlement and fraud within Tyco International. In 2005, Kozlowski was convicted of multiple counts of grand larceny and securities fraud, resulting in a lengthy prison sentence. Tyco International also faced significant consequences, including a tarnished reputation and financial losses stemming from Kozlowski's misdeeds. The ethical implications of Kozlowski's actions reverberated throughout the corporate world, serving as a cautionary tale of unchecked power and greed in leadership positions. Kozlowski's downfall underscored the importance of ethical conduct and accountability in corporate governance, highlighting the need for transparency and integrity in all levels of leadership. Conclusion. As we reflect on the key scandals of Bernie Madoff's Ponzi scheme, Enron's corporate fraud, and Dennis Kozlowski's financial misconduct at Tyco International, A common thread emerges: the critical importance of transparency and accountability in the financial world. These scandals serve as stark reminders of the devastating consequences that can arise from unchecked greed, unethical practices, and a lack of oversight. From the billions lost in Madoff's scheme to the collapse of Enron and the lavish excesses of Kozlowski, each scandal has left a lasting impact on the financial industry, reshaping regulations and perceptions of corporate governance. It is imperative for viewers to stay informed about financial news and practices, to be vigilant in scrutinizing the actions of corporate leaders, and to demand accountability and integrity in all aspects of the financial world. We invite you to share your thoughts on these scandals and to join the conversation on the importance of transparency and ethical conduct in the financial sector. Together, we can strive for a more responsible and trustworthy financial landscape.